All right, we should be live now.
Awesome. Just gonna wait a few minutes for other folks to join in and start. Oh, great, I see Lee's here. One question for you, Ian, can attendees, if we want to post something to attendees, can they see in our chat box, or we don't have that interaction?
No, so that's going to be facilitated through Manjita. If you want to say something, well, then if you're on the hub, you could communicate directly there. Otherwise,
okay.
Yeah, just let her know.
Okay, maybe I'll log into the hub because I might send out a few references or papers to folks as people are talking. And for any other panelists, if there's like a paper of yours or some work that you've done that you want me to send out to the audience, post it here, and I can, Manjita, or I can make that link happen. Awesome. Ian, can you see what I just posted in the chat to the audience? Just want to make sure that's working. When I clicked on the session chat in the hub. Or Manjita, just to confirm, or someone chat back to me maybe.
Yeah, I was just about to check, but my chat just broke. Does anyone else have that problem?
I'm trying to click and it's not responding.
All right, well, okay, you can see my chat. All right.
Yes.
Okay, great. Awesome, thank you. Carly Lobas, whoever you are, I wish I could see you when we were live. Okay, great, we're gonna get started then. Thanks so much for everyone who came in the audience to check out our session. I'm really excited about the conversation that we're gonna have today. Just kind of warning, this is a no slide session. So when I say we're gonna have a conversation, I really mean it. And so this is probably the type of session that you could treat a little bit more like a podcast and put it on your phone, go take a walk outside. You could even take a break from screen time if you wanted, and just listen in. If you are at a computer, we have the chat box open for Q&A, and we've left a lot of good time for you to ask your own questions of the panelists. So keep those questions coming, and I'll moderate that and make sure that that gets to our panelists today. We have a really awesome lineup, I think, for you all to have an interesting conversation. And it's about, to me, one of my deepest, most existential questions as a scientist working in this space. So I'm Beth Tellman. I'm a postdoc at Columbia University. And the goal of my postdoc really has been to understand how we use satellite data to inform different kinds of adaptation strategies like insurance. I've been working mostly with satellite data for flood mapping in Bangladesh at the International Research Institute for Climate and Society at Columbia with Dan Osgood, who's here, who's one of my postdoc mentors. And as much as I love all of the data science and machine learning that I get to do to write better algorithms to make better flood maps and do data fusion to support new types of insurance, there's a lot of social and ethical questions that always come up for me about what it really means to ensure a climate vulnerable population, and how does that adaptation strategy fit in with all of the other things that we should be considering when we think about managing risk and climate risk. So we're going to dig into some of those topics today, and you're going to get to hear from experts on a few sides of that. Just a couple of statistics I want to state before we dive in for folks who are a little bit less familiar with insurance and why are we talking about insurance in the context of managed retreat. First is that the majority of losses from natural hazards, and well, they're really not natural hazards, from hazards that occur in the world are not insured. 70% actually of insured of losses globally from disasters have no financial insurance. And that number is even higher in developing countries. It can be up to 90 to sometimes 99%, and in some cases almost no coverage. And that has real demonstrated consequences. There's research that shows, this is research Munich Re has released, that countries that have a good insurance and natural catastrophe protection system over the long run from disasters don't reduce their GDP growth. And countries that don't have access to natural catastrophe insurance can reduce their GDP growth 10 years following a major event as low as 10%. So we can get these wildly different development trajectories based on who had access to financial capital to recover and who didn't. And insurance has been proven as one of the ways that can fight against that variability. We've also seen a lot of growth. Dan will talk about this. He's been working on it for decades of insurance, not just for country and city governments and budgets, but all the way down to the household and farmer level. Good insurance from for farmers that's really supportive. And there's a really big difference between good and bad insurance. Research, Eleanor Benamy did a great review paper I'll post here to the audience this year, but shows that it can lower malnutrition, stabilize income for farmers, allow people to invest more in productive assets, and not have to make tough livelihood decisions like pulling your children out of school in order to make ends meet at your home. So good insurance can play a really important role and a buffer in sustainable development, and that's proven for farmers. But, and there's a big but here, a lot of what I think we'll talk about today, bad insurance can make farmers worse off. So if the insurance product they bought doesn't actually pay out when they have a loss, they would have been better off not buying insurance at all. Subsidized government insurance can incentivize people to stay in risky situations where maybe we don't want to spend our public dollars that way. Here in the United States, I think we've had some really tough experiences about our own national flood insurance program and the amount of money that taxpayers really can no longer afford to pay to continue rebuilding homes and floodplains along the coast. And we're starting to ask ourselves, is that the right way to spend public funds? And should we be adapting differently? And I think Salim will touch on this a little bit, but is insurance the best way to support sustainable development in a climate changed world where the people that are causing most of the climate change are very different than the people who are experiencing it? Is it really people's responsibility in the global south to pay for that reduction in variance and to be the ones that foot the bill for insurance? There's a really important justice question here about what it means for the most vulnerable to pay for adaptation that I know Salim is going to touch on. So that's sort of my introduction of the issues and the tensions we're going to explore today in this panel. So that's most of what you'll hear from me. I'm going to let everybody else talk the rest of the session. And I'd like to introduce the panel that we have today. Dan, would you go first, introducing kind of yourself and your work and how you relate to this topic?
Okay, yeah, so thank you, Beth. That was a great introduction. I'm Dan Osgood. I'm the lead of the Financial Instruments Sector Team at IRI, the International Research Institute for Climate Society within the Earth Institute at Columbia University. I'm an agricultural economist, and I've begun my career working with how climate and climate variability impacts low-income people, and to some extent how much that relates to migration and what migration means to these communities, what climate means to these communities. Over the past decades now. I started very young. I've been exploring how and doing research on and providing support on some projects with many of the panelists here, coincidentally, on index insurance projects, helping build those projects so that they're solving the problems that they're supposed to be and serving the people they're supposed to be. And these projects have scaled from a few thousand to many millions of people around the world, mostly in the global South. All right, thank you.
Awesome, Matthew, you want to go next?
Yeah, okay, sorry. Well, good morning, good afternoon, everyone. So I'm Mathieu Dubreuil, and I'm Senior Insurance Advisor for the World Food Program. I've been in this field for 14 years now, more or less, but with WFP for the past 7 years. And WFP has a very interesting approach that is quite different from the majority, let's say, of the stakeholders in microinsurance, at least, because we're implementing an integrated risk management strategy that is based on 4 key components. And I think for today, we'll mainly focus on the two first ones, which are the risk reduction. So the participants are actually implementing risk reduction measures to reduce their overall risk, climate risk exposure, but also build their resilience, reduce their food gap, and pay for their insurance premium. Then we're having the risk transfer, which is about like index insurance products. And we've been collaborating with IRI since the very first stages, meaning 2011, I suppose, in Ethiopia. The 2 other components are also very important. One is the risk retention, which is mainly savings, and it's also very important for 2 reasons. One, to manage the most frequent shocks that are not being captured and covered by insurance, and also to build the investment capacity of participants. And the last component is the prudent risk taking, which is mainly about increasing investment capacity and increasing income generation so that we can save more and we can buy the premium, but also like ultimately we no longer need WFP or any social protection system to pay the premium on their behalf. So currently we're implementing this approach in 12 countries, mainly in Africa, but also in Bangladesh and in Guatemala and Nicaragua. And in 2020, we had roughly 900,000 beneficiaries. Over to you.
Awesome. Thanks so much. We're excited to hear more about that. Salim, will you introduce yourself and how you integrate with this topic?
Sure. Thank you very much, Beth. Great to see you again. Good evening from Dhaka, Bangladesh. My name is Salim Ul-Haq. Please call me Salim. I'm the director of the International Center for Climate Change and Development at the Independent University, Bangladesh, based in Dhaka, Bangladesh. And I've been working for the last several decades on what we call community-based adaptation or locally led adaptation, working with the most vulnerable communities in the most vulnerable countries, particularly in Asia and Africa, on building their capacity to adapt to the impacts of climate change. I have very little knowledge, if any, on insurance, but I guess the overlap with the insurance arena comes from the fact that I now increasingly work on the topic of loss and damage from climate change, which is the reality of climate change. And I would argue that the transition from 2020 to 2021 into this new decade has actually seen us cross the threshold to where we are actually seeing human-induced climate change attributable impacts of climate change and loss and damage because of that. A good example is the drought you're having in Western United States right now. These are now attributable to the fact that human beings have raised global temperature by well over 1 degree since pre-industrial. And therefore, there is no such thing left as a purely natural climatic event as we used to have pre-2020. And therefore, there is a cause and effect. Some people are causing the problem and some people are being affected by the problem, as Beth said. And the poor people that I work with didn't cause the problem, but they are the ones suffering from that problem. And now I have nothing against using insurance or index-based insurance to help them, but I am a skeptic. They can't afford premium for the insurance, and why should they have to pay a premium for insurance, insuring themselves against a problem that rich people in rich countries caused and they didn't? So number of skeptic questions, if you like, one on practicality of how do you do it, and one on the morality of why should they have to do it. Anyway, I'll leave it there. Look forward to the discussion.
Awesome. Thanks so much, Salim. Birgit, will you go next?
Yes, thank you. My name is Birgit Müller. I'm from the Helmholtz Center for Environmental Research in Leipzig, Germany. And I'm a social ecological modeler looking at feedbacks in socio-environmental systems and using computer models, for instance, to study land use in dry lands or also in Europe, and especially to look at impact or how to deal with climate risk and how different options, like for instance insurance, may change behavior of land users, and in the long term, what could be the effects on the socioeconomic side, but also on the ecological side. And one contribution I would like maybe to mention here was together with I did with Lee Johnson to do a literature review on in developing and also developed countries on agriculture insurance and how insurance what has as potential positive effects, but also negative side effects. And maybe we can put this in the chat later. So yeah, to look really as insurance as part of a coupled social ecological system. Thank you.
Awesome. Thanks. Lee, will you go next?
Yes, hi. Good morning from Oregon, and thank you so much for the invitation, Beth. It's really a pleasure, and I'm very excited to have this conversation. So I am a professor at the University of Oregon in the Department of Geography. I'm a human geographer, primarily a political ecologist and economic geographer, although also kind of trend towards development studies. But I arrived here in a sort of backwards way. I did my PhD dissertation studying the production and management of climate change knowledge in the reinsurance and insurance industries, primarily with respect to North American hurricane risk, thinking about how reinsurers and third-party catastrophe modeling firms were creating a space in which capital could flow despite climate risk, and thought a lot about the relationship to catastrophe bonds and catastrophe bonds' ability to do what I called splintering protection, where some parts of the environment would become protectable via insurance, particularly through things like catastrophe bonds, where large swaths of a landscape would become uninsurable through traditional means. And that's something that we actually have started to see happening in places like Florida, where there are high-end developments and particular real estate where enough risk-friendly capital can be found within certain markets, insurance-linked securities markets, and to kind of sustain a growth machine in the context of places like Miami, whereas many parts of the state, as we know, of course, are increasingly uninsurable by traditional means, and they're certainly not accessible or affordable. So I have then I switched after getting a bit tired of thinking about very high-end like urban settings. As a postdoc, I started from the other end of the spectrum, looking at very rural places where microinsurance was being developed, particularly looking at index insurance in northern Kenya, and thinking about the development sector's engagement, and how these sorts of projects that IRI and many of you have worked on are put into practice on the ground. So I've had the pleasure of crossing paths with some of you on numerous occasions. And then more recently, I've also looked at how these spaces connect with some of the larger projects developing around sovereign risk pools. So things like the African Risk Capacity Facility. And so one of my most recent papers tries to think about all of these spaces from micro to meso to macro level insurance together in the context of the African development sort of enterprise between different agencies, donors, and governments. So I'll put that in the chat in a moment.
Awesome. Thanks so much, Lee. And last, Max, you want to introduce yourself and then take us into some of the questions we developed, and then I'll start working in some from the chat in the audience.
Awesome. Yeah, we'll do. Thanks, Beth. My name is Max, and with Beth, I am co-chairing this panel. Like Beth and Dan, I am affiliated with the IRI at Columbia. I work as a staff associate on Dan's team, where I sort of work as the intermediary between our academic researchers and humanitarian partners like WFP, who are actually implementing these insurance projects. So we work on improving the design of insurance through connecting it to research. My background before that, was actually in conservation, working in Namibia on rangeland conservation. And I think one reason I'm really interested in this topic is it really connects both those things. I think living in Namibia, I really got to see firsthand what it is to live in this, area that's actively undergoing climate change, as Salim mentioned, that is actually, not just ecologically marginal, but is changing every year and becoming less viable with each year. And so I'm really interested in this topic and sort of, what is the right way of thinking about adaptation or thinking about risk mitigation in these places that are really under existential threat. And with that, we've got some questions prepared for the panelists. We've asked the panelists to prepare remarks for a couple questions each in advance, but of course, to all the panelists, if there's anything that comes up as you hear other attendees' responses, or if you want to add anything, of course, feel free. So we'll do that and then move after that to Q&A. I see we've already gotten some good Q&A questions in the chat, so please keep posting those. So I'm going to start with our first structured question, which kind of sets the theme for the panel, which is, what do you think the role of insurance can or should be in relation to managed retreats? We've talked about a lot of types of insurance, from sovereign insurance to government insurance programs for property owners to micro insurance for farmers, but I think they all face a similar problem, which is this: does insurance prevent migration that ultimately makes livelihoods more vulnerable? Does it keep people from being displaced? Or does it induce vulnerability by keeping communities in places that are becoming less and less viable each year? So I know, Lee, I think you had mentioned you had some thoughts on this one. So why don't you start us off?
Thanks. So I jumped at this question because I think it's really fascinating the way that Beth and Max have connected climate insurance and, in the session description, agricultural insurance with managed retreat, because it's not often thought of this way, right? And this is, I think, one of the assumptions we need to test in this session and sort of see if the ideas can stretch and work together. And I also am not totally sure what we mean by managed retreat in the case of smallholder agriculture. So I'm gonna I know many others of you, Beth and Salim in particular, work a lot on flooding and displacement. So I wanna really focus in on smallholder agriculture in particular, and leave the other questions to the flood experts. But in the case of agriculture, Does managed retreat mean abandoning marginal lands? Or does it mean perhaps systematically switching? You know, we can think of ways in which managed retreat is not literal from a piece of land, but a transition to a crop that's has fewer water requirements or is seasonally more appropriate for a shifting season, right? So I'm also interested to hear Dan and Matteo's thoughts on that. But the assumption that insurance incentivizes staying in place via payouts, I think is really connected to a probably fairly global northern perspective that's linked to insurance for damage to homes and fixed structures. And that doesn't necessarily translate to damages to crops for smallholders, especially because that insurance coverage is usually partial anyways, and particularly with index-based or parametric coverage. So in many of the projects I'm familiar with, we're talking about payouts for, you know, a range of tens to a few $100s, and where you might have 5 camels covered and maybe 10 goats and sheep, right? So a payout in that respect is not going to by itself lead, I think, fundamentally change a trajectory around migration, right? So there's a whole other set of questions around transformations of agricultural practices that I saw also on the list that I think are maybe better connected to the agricultural space. But the other thing I wanted to raise is that there are all these standard expectations and standard expectations of the privilege of a right to home ownership in the global north. And those come with sets of legal and regulatory provisions around consumer protection and affordability. And those don't necessarily apply right now in an agricultural insurance space. So in many cases, that means regulation of insurance is actually for solvency rather than consumer protection. And insurers can charge what the market will bear, which sometimes is very little, which then also leads to a new rationale for government or donor support. So the question, I think, is what kind of insurance? Are we talking about market versus hybrid versus public insurance, and for whom? And on its own, I doubt that agricultural insurance is going to prevent migration in a managed retreat sense or keep communities in vulnerable spaces, just because I think the payouts are too small. And to actually meaningfully influence migration decisions, I think you need a much broader social protection infrastructure, which is, of course, what WFP and many other organizations are thinking about. You know, how do you create something that is more systematic and holistic, and also, of course, many governments are thinking about how it gets integrated into a whole social protection system. The last thing I wanted to say is to kind of turn the question on its head, because there has been a discussion which is connected in interesting ways to discussions about actuarial pricing for things like flood insurance in the United States. There has been a discussion of using some adjusted pricing to account for climate change in agricultural insurance. And I'm sure some of the other panelists can also speak to this with more specific examples. But from what I understand, that hasn't typically landed well. First, because farmers balk when prices change on a product that they were familiar with. And so there's an example in the index-based livestock insurance program in northern Kenya. They tried to switch to what was called conditional pricing, which wasn't necessarily linked to developing a climate indexed risk price, but conditional pricing that shifted as the data accumulated and incorporated data on recent losses and projections for the near future seasonal behaviors. And that landed really poorly because you shift the understanding that farmers or pastoralists in this case think that they have of the product. Why should it cost something different each season? And then, of course, there are all these technical questions about figuring out what that price should be in any particular season. And then the last most fundamental thing falls back on something that Salim raised very early on, is this question of the climate justice and or polluter pays principle. Why should increasing climate risk costs be sort of downloaded onto farmers? If we can account for that cost, shouldn't it be borne by someone or somewhere else? And I'll kind of circle back to that. I think there's questions later on that bigger question.
Awesome. Thank you, Lee. Yeah, I think that raises a lot of really interesting points. Just a couple of reactions from my side. One, you mentioned this question about sort of contingent pricing or pricing that reflects the possibility of climate change. I think this is certainly something that, and Dan and Mathieu can speak to this as well, that we've encountered in a lot of these projects where we work with private reinsurers, and they often, I think, have very different notions of how to think about climate change. They're often thinking about things on a 1 or 2 year horizon. And there's this question of, how do you account for trends? Do you account for the possibilities of longer term climate change in the way you price things that I think are really, to my mind, still very unresolved in the space. But you also mentioned, I think, to segue to the next question, one thing I want to ask Mathieu to respond to, which is, I think when it comes to insurance for smallholder farmers, I think there's a meaningful distinction between that and sort of insurance for, say, losses of property, where I think that for a lot of us, the theory of change of agricultural insurance is that it isn't just mitigating against losses, but in fact, unlocking some kind of productive potential that, productive investments that would be impossible or impractical absent that financial protection. And so I think when you talk about that and climate change, there's this really, I think, important question to segue to the next one, which is, for which types of farmers do you think agricultural insurance is best suited? I think, there's, the extremely poor farmers for whom, just remaining on that knife edge of sustenance is as much as we can hope for these products. And there's others who might actually have the ability or the capital or the labor to invest in things like improved seeds or fertilizer and actually unlock these investments that we always talk about. So I guess my question to you is, how do we think about which farmers insurance is best suited for? How does WFP sort of approach that question? And I guess to tack on something that Lee mentioned, how do we think about this question of who pays for premiums? Because I know that's something that always comes up in these projects as well.
Yeah, well, thanks a lot, Max. So I think the way we approach it for agricultural or rather climate insurance is that we see two types of participants or beneficiaries. On one side, we have the most vulnerable, and we definitely have a social protection approach. So if they are labor constrained, that they cannot work on these assets or implement adapted climate practices, then they would rather be under the sovereign risk pools like ARC, and WFP is actually subscribing to policies that we call ARC replicas. So we're buying with the government. I mean, the government is buying one policy and we're buying another one on the same risk transfer parameters. And we're also looking at if they're labor constrained, this is what we do. If they're not labor constrained and they can work and implement risk reduction activities, then they would rather be under the R4 or the integrated risk management strategy with microinsurance. So in this case, they will pay their premium with their labor. And then we're also having the better off or the commercial smaller farmers, still small, but they have a slightly better access to market and to financial institutions mainly. And so they would have to actually buy the premium. And there we can see that it's really difficult to find very good and efficient and sustainable distribution models. So when we look at the two, we have like two different systems and objectives. With social protection, we're first trying to protect the most vulnerable communities, ensure their food security and build resilience. And hopefully at some point, they will actually graduate and reach the commercial level and have access to all that. But of course, if WFP subsidizes the premium, we need to have like other tools so that they can actually grow and graduate. Otherwise, just insurance won't be sufficient. And this is actually like something quite difficult. In our different countries, roughly we are at 30, 40, sometimes 50% of cash contribution, which is already great. But we're still struggling to reach like 100% and within like 4, 5, 6 years. And the objective for the commercial or more productive farmers is more to improve and protect their investments, increase their productivity, and ensure their business continuity. It actually also works for the meso insurance policies. Like if an agri-business, for instance, wants to make sure that they're not having like a loss at some point in their balance sheet. So for both types, I believe that insurance unlocks productive potential. Productivity tends to slightly increase, and we've monitored that in Ethiopia and in Senegal, where we've done some impact evaluation, but this is also something that we see in all the other countries where we have a little bit more than 2 years of experience. But in my opinion, at least for the social protection level, it doesn't unlock access to finance the same way because, well, first, WFP works with very vulnerable food insecure communities who are usually completely disconnected to the market. They're not structured in cooperatives, and so they don't have like any weight on the market. So they're not interesting for MFIs basically and banks, and they're usually also like not very interesting for off-takers because they cannot like, aggregate and produce enough. For commercial farmers, yes, this is definitely something that I've seen. So for instance, right now in Senegal, so in Senegal, they have like one insurance company that is dedicated to agricultural insurance that is called CNAS. And right now with the agricultural bank, all the input loans are being insured with this insurance company. So there is definitely like a much better system. And I had seen that also like in the past when I was working before WFP in this country. Cooperatives were actually like selecting their participants who wanted to take loans. And the MFIs also were specifically targeting cooperatives who were insured to give them loans. So we do some monitoring after the payouts that we call post-distribution monitoring to re-understand how the distribution was efficient or inefficient, and to also understand the satisfaction and try to improve the system. And all the payouts allowed participants to buy food inputs so that they can actually replant, usually the next season, and pay school fees. And depending on the level of vulnerability, the share between these three items will actually vary. But I wanted also to give you like two other examples. So in Zambia, we do work actually with IRI, with the FISIP, which is the farmers subsidized input package of the government. And the government actually was initially just giving subsidized inputs to roughly 1 million farmers. And so they saw the importance of introducing insurance so that they could actually protect the farmers' investment, who also have to contribute a little bit, roughly 25% of the value of the package. And so they introduced it. So definitely there is also like an understanding that when there is an investment and there is a shock, like at least the farmers need to be able to continue. Ideally, they're even like protected enough so that they're not like losing more in terms of revenue or food security, but at least they should continue. And maybe to answer a little bit Salim's point at the very beginning, in Bangladesh, we're doing flood index insurance with a very social protection entry point, because we're working with wage earners only, so they don't really have like the capacity to invest and generate more income. And so we've been insuring 2,000 households last season. The conditionality to access this was to plant 1 tree. And this year it will be 2 trees actually. And the first year they got a payout of, I think it was $37 US. And what's interesting is that it's not only insurance where WFP was paying the premium for, but it's also like articulated with forecast-based financing system where before the flood hit, they also all received a transfer of $50. So, all in all, when it's quite well sequenced, there's a much better protection of these communities, but then we're definitely not talking about increasing productivity either. Over to you.
Thanks. Yeah, a lot of good stuff there. I'm glad you mentioned forecast-based financing, which is not something I initially put in this panel, but I think is very related to a lot of these questions. I'm also glad you mentioned FISP, partly because I've been thinking about it all week, but also because I think in my mind, it's in many ways a good model for how these sort of programs could be run, and that it is tied to this existing state program, this existing kind of social safety net, and tied to a government agency that already has a footprint across like all these rural areas of the country. And I think in many ways, that's the sort of thing I think for reaching smallholders seems like the most exciting and promising, is to like integrate this into existing social safety net programs. But I wanted to go back for the next question. That's a remark that Lee mentioned earlier, sort of regarding this idea that I think there's this notion of insurance keeping farmers in the land, and that like smallholder farmers in developing countries are self-sufficient, and that they get most of their income and resources from this land. It's very kind of US frontier notion of what it is to be a farmer that I think when you go to these countries is not at all reflected in the complex reality of how people make their livelihoods. And I think a good example that I've seen personally is working in Namibia. The government builds a lot of water points in the north for cattle, and there's this constant debate about whether or not build like in the southwestern US, whether or not providing these water points is actually helping farmers, or whether it's just putting more and more pressure on increasingly desertifying lands. That's ultimately sort of making things worse for everyone. So I think tying to that, my next question is, and I see that both Bridget and Mathieu have indicated interest in this one, but anyone else who's interested, feel free to jump in. The question is, how do you think insurance encourages or discourages certain land use changes, and how does that relate to climate adaptation? So maybe Bridget, why don't you go first, and then Mathieu, and then anyone else who wants to add.
Mm-hmm. Thank you. So the first issue is that I have the impression that long-term monitoring studies which really look at the impact on change of land use strategies are missing. So that would be really key also to have a better understanding on what's going on. What is done at several locations, randomized control experiments, for instance, which show, for instance, in studies in India or in Ghana, that application of or the availability of insurance may lead to riskier production choices. I think this is intended because they often lead then to higher short-term income. However, this could mean, for instance, also a switch then from subsistence crops to cash crops, which can, for instance, then also lead to other types of risk, perhaps, for instance, to dependence on price risk. And on the other side, traditional management strategies to cope with risk, like intercropping, where you have different types of crops to deal with drought, are then not carried out anymore. And these traditional strategies had additionally by-effects positive. For instance, by having different types of crops, you have a little danger of pesticides, or also a better soil fertility. So there could be then a side effect on social ecological side. And I just want to warn that we also have to see what have learned, or which errors have been made, for instance, also in the Northern Hemisphere. For instance, the US, they have now changed the Farm Bill Act, for instance, that I think in 2014, that they only get a high amount of full amount of subsidies if they have a minimal number of crop. And if you now see, for instance, in Europe, the Green Deal, which invests about $600 million euros in the next 7 years for climate protection and for environmental against environmental degradation. So I would really favor that it would be good to combine insurance with, for instance, incentivizing agroecological practices, which are good for climate protection, and really use also the money, for instance, to train farmers, or even if they have already probably the local knowledge on adapted practices to really carry this out. And maybe a last example is, for instance, in the US, they have the so-called Salt Saver program, because which has the aim that native grasslands are not converted to croplands, because they have such a high also climate protection part, and also for environmental side. And so, for instance, in this case, the subsidies for insurance are also reduced by 50% if such a conversion of native grasslands is in place. So I really would also argue that for this programs in Africa or Asia, to take this into account and not make the same errors as in Europe or in US have been made. Thank you.
Thanks. Yeah, and you, I think, to respond to one of the points you mentioned before I ask Mathieu to respond, you mentioned something I think that is really interesting, which is that you mentioned these studies looking at how farmers who received insurance moved over to things like cash crops, and these sort of longer term environmental and sort of livelihood impacts that might have. And it's funny because I feel like in a lot of ways, like the theory of change for index insurance would say like, this is a good outcome. Like, where people moving to riskier crops is precisely from like a short-term business kind of development standpoint what we'd like to see. But I think you identified exactly, I think, what we want to bring out in this panel, which is that that's not the only perspective here. We're also thinking about sort of the long-term environmental consequences of those actions is really important. But I'd like Mathieu to respond to that as well.
Yeah, sure. So as I was saying before, we have like the four components, and here I just wanted to talk a little bit like of the impact and what we've seen in the different countries between like the different ways that we're implementing the risk reduction. So for instance, in Ethiopia, which is the first country that implemented this approach with risk reduction integrated with insurance. So the participants implement community-based watershed management activities that have been developed by WFP in collaboration with the Ethiopian government. And so they're implementing asset creation. In order to build long-term resilience, farmers work on soil and water conservation, water harvesting, small-scale irrigation, agroforestry, and reforestation programs for a number of selected days, in addition to the productive social safety net public work requirements to receive the insurance policy. So they work on PSNP to get like the cash or food transfers because they are food insecure, and they work additional days on these activities to actually pay their insurance policy. And more specifically, the assets in 2020 were building trench bonds, micro basin dam construction and maintenance, cut of drains and flood diversion, tree planting, and so on. I mean, I've been a little bit to the field, and in the first locations in Tigray where we started the implementation, we really see like the difference with the landscape and the productivity of the farmers that is really impressive. And I think that's also like one of the key lessons is the long-term investment in these things. Too often with the asset creation work and the food or cash transfers, because people are food insecure, and that's actually the case for the PSNP, where it lasts 18 months, 2 years, 3 years, and then then the work is out. And so it's not sufficient to actually like make a change in the productivity and in the overall restoration of the landscape. But definitely insurance was just like an additional incentive to participate to this work, because sometimes the public work is not necessarily impacting risk reduction to climate shocks. In Zambia and in Mozambique, on the other hand, we have taken like a completely different approach, mainly because there was no asset creation work from either WFP or the government. So we helped the government to to scale up the application of conservation agriculture principles. And so the idea was that the Ministry of Agriculture, usually with FAO in Zambia, was training lead farmers who were supposed to train 15 follower farmers to apply conservation agriculture. But for that, you have like three main principles: minimum soil disturbance, mainly no tillage, permanent soil cover by crop residues, and crop rotation. But also for applying conservation agriculture principle, you usually need to also like apply some inputs. And so it was actually like pretty difficult because only the lead farmers had access to a package of inputs that was provided by, I think it was FAO back then, but not the follower farmers. So it's cool to be able to apply the CA, but that was not sufficient. So initially the idea that we had was that if they apply 1 hectare of CA and like apply like these three principles, then WFP will pay the premium for these farmers. And it should actually be an incentive for the MFIs in the region to give them some loans so that they can purchase the input package. So we did that in Zambia the first year, and it was actually really difficult because not of this approach, but the overall economic situation. There was a devaluation of the currency, and so the farmers had, faced like some serious difficulties to actually repay their loans. And fortunately, we're working back then with Vision Fund, who had like a very interesting credit system that was called, of course, I've forgotten the name, I'm very sorry, but it's being implemented in 6 countries. And basically, because the index triggered, the index that they had triggered, they could disburse some loans to the R4 participants, who, thanks to that, were actually able to repay the initial loan. And in the end, 96% of the participants were able to repay the loans. Otherwise, they would have been like in credit default. And just to give you like a broad example, but in Senegal, in our impact evaluation, we've noticed, thanks to the asset creation work, like a very significant improvement of the productivity on rice, because they were working mainly on small irrigation systems, but also outside of what WFP was doing. But thanks to the recommendations that was provided by the index insurance product window that was during probably 20-30 days, based on the actual statistical optimum window. We've seen some maize cooperatives in 2012, after a couple of years of implementation, to recommend to their members to actually shift the planting dates to this planting window, so that they would actually like improve statistically their chances to have like to not have like some failure and to optimize their yield. Over to you.
Thanks, Intu. Lots of good stuff there. We're also getting a lot of really good questions in the chats, and so I want to make sure we have enough time for Q&A. I've got 2 more structured questions here, which I'd like to ask Salim to respond to, but other panelists, if you wish to add to that, of course, feel free. And the first question, I think, segues really well from what you were just talking about, Mathieu, which is, what role, if any, can community-based natural resource management play in forestalling environmental tipping points? And also tying this to insurance, how could insurance help or hinder these kind of community-based resource management strategies?
Great, thank you very much, Max. This is a fascinating conversation. Speaking from my end of the spectrum, which is working with the most vulnerable to climate change communities in some of the most vulnerable countries, and as a corollary of vulnerability, often some of the poorest people in the country and in the poorest countries. Hence, the market mechanism of insurance hardly ever reaches them. And as Mathieu was explaining of the case of the pilot project in Bangladesh, many of them are agricultural laborers. They don't even own the land they're farming. And so they don't have assets. The question then becomes, in my view, what are the opportunities for the insurance sector, both the private sector companies as well as the experts working in that domain, to engage in supporting these poorest communities adapt to the impacts of climate change. And now, as I said, increasingly having to deal with genuine actual loss and damage because of human-induced climate change. I would encourage you to work on this because it's going to get bigger and bigger. It's not going to get smaller. And it's going to be a bigger and bigger problem. It's not going to get smaller. So the days of trying to ignore loss and damage are over. We're going to have to deal with it at the global level, at multiple levels, including the heads of government needing to recognize it in the UN Framework Convention on Climate Change, which they've resisted doing for quite a long time. However, in the practical sense, I see an opportunity here for collaborative research. And I'll offer you an example from my country, Bangladesh, which has been a pioneer in developing adaptation to climate change from the national planning level to the local level, and very specifically on community-based adaptation, empowering and enabling the most vulnerable communities to adapt. Nowadays, we call it locally led adaptation. And we have done quite a lot in this arena. So the opportunity that I see is for those people who have an interest in bringing the expertise of the private sector and the experts to find hybrid products that can be delivered for the most vulnerable. It will have to be subsidized by the public sector somehow, either a donor government or the national government. But nevertheless, there are opportunities for public-private partnerships to develop packages that can enable these communities to plan better, be better prepared, and deal with the consequences of climate change when it occurs. And in that context, we are in the process of developing a very interesting pilot program, which is actually a public-private partnership arrangement under a relatively new a government authority called the Public-Private Partnership Authority under the Prime Minister's office, to develop something we are calling the National Mechanism on Loss and Damage. And it's a 2-year pilot project where we invite the different players who are already in this space, experts, insurance companies, others, to join forces. Quite a few index-based insurance products are already being trialed here. We heard about the WFP one. We've heard about the forecast-based financing by the Red Cross and various others. Let us learn together. It's a 2-year program, what one might call an action research program of trying to address loss and damage from climate change, which, as I said, is going to get bigger and bigger and bigger as time goes by. It's not going to go away easily. And we're all going to have to try and figure out ways that we can deal with it. Obviously, rich people in rich countries will also have to deal with it. But I think poor people in poor countries deserve a lot of our collective attention to see if we can help them. Maybe I'll stop there.
Thanks very much. And I think that segues well into our last prepared question before Q&A, which then kind of puts a bow on it, which is, how should we think about the choice of market-based adaptation strategies like insurance versus policies that are centered on direct reparations for harm, like, as you mentioned, loss and damage, or like climate refugee resettlement? Do you feel like sort of the official discourse is currently too focused on one of those options over the other? And I'd like to ask, I know Lee had some thoughts on this, but also like the panel in general, if they have thoughts before we move to Q&A.
Well, I'm glad to hear Salim's thoughts, which I think do segue directly into this. And I was imagining that he would have comments on this as well. So I just wanted to say also about the way that the question was framed was, well, what are the trade-offs between a market-based approach and an insurance approach? And an insurance market-based approach and a loss and damage approach. And I wanted to point out that insurance, of course, is not always market-based. And as Salim was also just pointing out, there are these hybrid models. But also, the social welfare schemes of the 19th century socialized losses in ways that had not yet been attempted by any state bureaucracies, right? So there's nothing to say that there are not new forms of solidaristic insurance waiting to be discovered and put together. But on the other hand, there has been a concerted attempt by insurers and reinsurers to align themselves with loss and damage in particular ways. As those same nation state parties that house those insurers and reinsurers have scuttled discussion and consideration of the word compensation in the UNFCCC negotiations, right? And it was deliberate. You can trace how the uses of the terms risk and insurance emerge in the UNFCCC documents. So I do think it is important to retain the political position about compensation from a climate justice perspective, or reparations and repair, and recognize that private insurance cannot ever be equivalent to public solidarity, even if donors in wealthy countries are subsidizing it, as they well should. And then finally, I just wanted to ask whether, to be a little bit provocative, and ask whether we should be thinking about insurance as climate change adaptation per se, because that's asking insurance to do two different things. One is to have a sort of disciplinary and preventative function, and the other is to have a compensatory function. And those two things are politically fraught to try to hold together. And we have to make some major compromises when we try to get it to do the two things at once. And so I think there's a case in the loss and damage pillar, at least, for decoupling relief and the sort of compensatory functions of insurance from adaptation, which is more corrective.
Absolutely. I think that's a really useful intervention. And Beth, should we let people respond to that a little bit more before we move into Q&A, do you think? Or should we move straight into audience
maybe
questions?
let Salim respond since he's talking.
Great. Thank you very much. So Lee, that was very good. So I agree with you entirely that the loss and damage issue is a much, much higher level issue between polluters and the victims of pollution. Greenhouse gas emissions is not a victimless pollution. There are victims of that pollution. And that's not right. That's immoral. It's unjust. It should not be allowed. And the perpetrators of that pollution must be held to account in some form or shape, whether it's under the UN Framework Convention or court cases or who knows what. But that is a big, big issue. And it's going to haunt us if we don't tackle it. It cannot be swept under the carpet. We can't put our heads in the sand and think it'll go away if we ignore it. It won't. So that's one level of discussions where these need to be taken into account. We need to be thinking about them. And I would say we need to reach out in solidarity with each other to take some things forward. And that's where I come to the second half of my my suggestions or interventions, which is there something practical that we as scientists, researchers, working with private sector, working with public sector, can put forward as hybrid solutions, where the skill sets of each of these stakeholders can be brought together to solve this bigger problem, and do pilots to show that if they work or don't work. If they do work, how do we scale them up? But what I've seen so far of the pilots on index-based insurance have been some good examples, but I don't see them scaling up. And we really do need to scale up. Climate change is happening, and it's going to get worse. Every year it's going to be worse than the year before. And we're not at all ready for that. And that's what I fear. But nevertheless, let's see what we can do.
That's a great point to end it on. And I'd like to turn it over to Beth now for the audience Q&A.
All right, we have, I think, 9 awesome questions from the audience. I don't know if we'll get through all of them, but I'll definitely get through the ones that were upvoted first, and then we'll go from there. I'm gonna start off with the first question that was asked, which I think Birgit is interested to respond to, which is, in regions of the world where insurance is privatized, how can we ensure that people won't be priced out of coverage, creating yet another scenario which displaces those who contribute to climate change the least? This question is from Carly Lovas.
Maybe I can't give a solution on how to avoid this issue, but just also to confirm this may be an issue. There are studies going on which investigate to which extent formal insurance can crowd out informal risk-sharing networks. And in the moment, these are rather stylized experiments or randomized experiments, and empirical studies are still missing. However, these experiments have shown there could be a change of behavior. For instance, if people don't then buy the insurance either because they can't afford it, or of other reasons. And this could be an issue that then people which can't afford the insurance are not included in this informal risk sharing networks anymore. So I think it would be good to create or to design also formal insurance in such a way, rather to foster these informal networks. And there are examples which show this could be good complements, because these informal risk sharing networks work well, for instance, for idiosyncratic risks, but for covariate risk, where a whole region, for instance, is hidden by a drought, there formal insurance can be very helpful. That's just another point really to which should be have in mind to avoid that people fall out of traditional risk sharing. Thank you.
Thanks. Dan, you want to add more?
Yeah, so I think that the question is a very important question, and I think also Bridget has highlighted an important issue. So insurance is one of those things that if it's not creating value that's more than its cost, we probably shouldn't be doing it. And I think that's the thing we have to keep in mind. And so if there's informal risk sharing that could manage the risk more effectively than the insurance, that should be what's happening. Also, if there's things that the farmer could do to prevent the loss, like plant later if the season is starting later, or not take out a loan for risky crops in a year where there's bad rainfall, the farmers should be doing that. If you could work through with the communities, you should be doing those kinds of things. I think this question about how low-income people can afford insurance comes only if it reaches all people, is that the insurance has to be providing a value that is higher than its cost. If because of the insurance, that makes it safe for me to say, invest in a plow animal because I can manage the risk. And because I have the plow animal, I am more productive and making much more money than the insurance premium, then the insurance is doing its job. And it usually needs to be packaged with these other things. And so I think we should not be thinking about this as we need to get insurance to people. We need to be thinking about it. How do we design insurance as a tool that could be helpful in these contexts? And as people have been mentioning, there's sort of the farmer's perspective with the insurance about, for example, getting an ox to be able to plow your field or something like that. And then there's also this food response, which may be a disaster responder, like the World Food Program or a national government, to say, we respond to these food crises or these climate-driven crises, and we have ways of responding to them. And the insurance could make us more efficient after we've exhausted the more effective ways, and the insurance should be specifically designed to be complementing these ways. And we should be saying, oh, the insurance is actually creating value more than we're paying for it in order to make it work. Thanks.
Thanks, Matthew. You want to respond to that as well?
Yeah, well, it's actually a very interesting question, but no. So I just wanted to add that very often when we introduce micro index insurance, there is like an expectation from all the stakeholders, but mainly the end users, that the product will trigger as soon as there is like any shock, which is a problem, because then the product would be like extremely expensive, and we know that insurance is very efficient when there is when it is positioned for the least frequent but most impactful shocks. The problem is that when we do that and we have like 2, 3, or 4 payouts within the last 20 or 25 years, then it's not visible, and it's not satisfying for the people. And that's the reason why I also believe that we need to connect microinsurance with savings and macroinsurance with contingency funds and other tools, so that we actually have this capacity to also show that this is a bad year, but it's not catastrophic enough to trigger insurance. And so we can also like better educate the people, because I believe that on this call, we're all insured somehow, and no one actually wants to use our insurance, and not like every 2 years or 4 years when it's like about housing insurance, we just never want to use it. But for that, we also need to see that, well, the rest of the time, it's because, I'm actually like better off without using it. And it's still like very difficult. But I believe it's true for micro, and it's also true for governments.
Yeah, Lee, you have a response there?
There was one,
Question.
Can I just jump
All
in
right.
quickly?
Dan, then I'm
chat
going
is,
to
I
the
think,
next topic.
yeah. I wanted to also, I was anticipating that Mathieu might cover this, but he's actually, what he's chosen to cover is much bigger picture. Many of the micro projects, in order to make them affordable to farmers who cannot pay the cash for the insurance, and R4 is the example that is quite exciting. What that project will do is it will allow farmers to use their labor to work for insurance. And so farmers will be paid to work on projects like, for example, for reforestation or composting. And with that labor, the dollar value of that labor can be used to purchase insurance projects. But in those cases, the insurance still needs to be worth its value in labor. Thanks, and apologies.
Awesome. Thanks, Dan. Next question we got from Alex DeSherbinen, who's at Season at Columbia. And he wants to know, given all the overhead of insurance, as well as development assistance, would just direct cash transfers to farmers with some conditions work? What have we learned from the development programs that have taken this approach? Could this be seen as reparations? Lee has thoughts here.
Yeah, so I love this question, and I've thought a lot about it in a broader sense, because there is so much money that has to go to pay transaction costs, and also the calculation to develop a properly vetted, actuarially fair program, and then all of the, just immense amounts of delivery costs, which entail everything from, getting your agency structure set up, enrolling beneficiaries, if you've got a, fully subsidized program, or selling the product, training your potential clients. And that's just massive. And most practitioners, I think, would say that that was dramatically underestimated early on in the turn towards index insurance. So those are really huge costs that you could potentially take some of them out of the equation with something like direct cash transfers. You still have to, you can't get around the beneficiary question, enrolling people somehow, setting up a financial distribution network. So the UK DFID did a, large scale hunger safety net program cash transfers in northern Kenya, and the index-based livestock insurance program led by the International Livestock Research Institute did a sort of comparison, tried to do a side-by-side comparison of the efficacy and impact of the cash transfer program versus index-based livestock insurance. So they had a quasi-randomized controlled trial with different villages that were and were not part of the both programs, and one program versus the other program. And what they found was that, if it's kind of a horse race between the two, the insurance does do a slightly more cost efficient job at per unit welfare benefit, and had more positive impact on things like milk production and sort of livestock asset productivity. But the question is kind of the scope, with any cost benefit analysis, how many externalities did you fold into this calculation, right? If you think about the scope of all of the sort of insurance literacy, financial literacy training, development partnerships, and so on, I imagine that if you include all of that in your package, it's probably comes out a little bit short for insurance in that case. But in any case, you don't get around the question of beneficiaries, right? Of identifying the beneficiaries. And that's something that the Kenya-based, the livestock insurance program, which is a government-funded safety net, has also struggled with as well. To how do you find the people who need it the most? And you have that problem with cash transfer programs as well as insurance programs.
Yeah, Matthew, you want to add to that? Thanks so much for that really interesting example, Lee.
Yeah, well, thanks a lot. It's actually it's great. So I wanted to say two things. The first one is, well, yeah, there is in general, we tend to think about insurance in percentages of premium rate. And so it's true that when you're having a 20, 25%, 30% premium rate, well, basically at some point it means that your product is so expensive that you'd rather, just save for yourself, and you'd be a lot more efficient because you don't have to actually pay for the overhead. But then, so we had a series of workshops with Dan and team and some other reinsurers about the impact of climate change and climatology in the design of indices and in the pricing. And one of the things that we also said that it's not only the premium rate itself, but it's also the premium. So what is the actual value? And at which cost are we setting the product? Because if we're insuring $20 of an input bag, or if we're insuring $400 because the whole livelihood, then it's completely different, and it also depends a lot on the premium structure. So that was one point. The second point, building on the Kenya example, which I think is really important, it's the whole humanitarian system. And insurance, index insurance in particular, is supposed to trigger early actions, whereas FBF, coming back to my example before, is supposed to trigger anticipatory actions. And the traditional response to drought in particular is usually triggered 6, 9, 11 months after, because the time that you do the IPC that you actually can target, maybe even fundraise. And so it's it's a sequencing of activities, and probably they may even be more efficient altogether when you reduce them and you try to optimize the response, so that you're actually optimizing also the size of your program, because sometimes a too large program is actually too costly. And too small is just not viable either. Over.
Awesome, thanks, Matthew. All right, we're gonna sneak in one more question, and then Dan, if you want to close out, or I can do two more, Dan, depending on how long your closing comments are. We have 12 minutes left. I know, Matthew, you were excited to respond to these two, so I'll sort of let you pick. One was from Ellis Foley, and they wanted to know if you could comment on how industrial scale agriculture insurance works, and other tools for this industry to transition to more sustainable practices or productive crops. And then the second is, what are the cultural and traditional values that might lead to resistance or new approaches, such as new crops, new crop practices?
No, I think I had said I could answer more the difference between weather index and area yield.
Oh, you meant the Zambia question. Okay.
Yeah.
All right.
Maybe I can try to do like both like very quickly. But so with weather index, usually you're either using data from like weather stations, rain gauges, and so on, or satellite. Whereas with area yield, you're using like data from crop cuts. I don't oppose, but I think like both have definitely like pros and cons. With weather index, usually you have like free data, except if you want to really like monitor each specific fields. You have the data almost directly. So right after the season, and even sometimes during the season, you can trigger a payout and maybe like, distribute, I don't know, short cycle crops, which definitely you cannot with area yield. The big problem that I see with weather index, and also it's very transparent on the process. The big problem that I see with weather index is the fact that you tend to focus usually on one type of shock, because when you try to add several risks, then usually the premium tend to increase very quickly. Whereas with area yield, one of the great things is that all the covariate shocks are actually like embedded into the data set. The major issue is that it's costly to do the crop cuts. Usually you don't have the data set. So some stakeholders actually have developed some ways to reconstruct data sets thanks to machine learning and to no longer need too long data sets, but ranchers are not always very happy with it. And also like the timing, because you're having like your data 4 or 5 months after the end of the season. And what we were saying just before is that you have like a lot more efficiency when you're doing a payout right after the end of the season than when you're doing it 6 months after. And even in terms of visibility and communication, that's better. So actually, in some cases, it's interesting to do sometimes both, weather index and area yield together, because then you're recovering like all the shocks. Because definitely for the farmers, well, they tend to prefer what's coming out of their field than just what's coming in. Then about like the cultural and traditional value, the question number 9, I just wanted to give like the example that I recently saw in Madagascar. So we were visiting the farmers, and in the south of the country, they were growing maize, and they had like 3 consecutive sowing failures. And in the end, we're having like a full payout after the end of the first season. So every farmer is getting like $100. But then I was asking to the farmers, but why are you still growing maize? Because definitely the conditions, the rainfall conditions in the south of Madagascar are not good for maize. So we should probably not even insure that. But because it's the basis of food security, that's what we do. And so I was like, why don't you do millet, for instance, or sorghum? They were like, well, we can eat it, but we cannot grow it, which I think is really interesting, because, I mean, if you don't also like, lead to that change at some point, well, you're not like optimizing the situation. And at the same time, they also like, they don't want to move except for a short period of time, because recently there was a displaced camp because of the famine. So that's really difficult. I think that's well presented, and maybe to most advanced or most productive farmers, smaller farmers, probably they can adopt better practices, better crops. And that's what we did also like in Kenya, where we only selected drought-tolerant crops for farmers, and not maize, because that's the staple crops that they all plant in Kenya. And otherwise it would have been like, still perpetuating probably like not the most efficient practices for them in terms of food security.
Awesome. Thanks, Matthew. All right, Dan, you wanna close us out? Thanks so much to all the panelists for giving your thoughts and for other audience questions. You had so many good ones. I'm sorry we didn't have time for all of them. Yeah, Dan.
All right, yeah, so I think from the panel and the audience, we see there's a lot of different things to think about, a lot of really interesting questions. And so there's a couple fundamental questions to remember. And so I just wanted to try and talk about what some of those are as we wrap up. And so the big question really is, can I remember what the questions to remember are? So yeah, I'm a funny guy. So one thing is that we should always be thinking about the role of the insurance and what's right and wrong, and if it should be used in terms of what it's for and if it's useful. So as we think about things like migration and climate, those some of the ways that migration can be related to climate is that we can imagine someone like a farmer or someone in an analogous context who in a bad year, they might seasonally choose, I'm not going to farm this year. I'm going to go do something in the city and tourism. And that might be a kind of migration that makes a lot of sense. And then they might move back and bring their labor back to the farm the next year. There's other kinds of migration where I've been slowly building wealth and I'm going to sell my farm and then move to the city or move somewhere else, move somewhere where the farming conditions are better, transition out of pastoralism or into a different livelihood. And so basically, because I've been managing risk and building wealth, I can transition into something that is a better adaptation and maybe move somewhere different as part of that transition. And then there's the kind of migration, which is not a managed migration, where I've been really hit, I've run out of food, I've lost my farm, I end up in the city and have to take any job possible or I end up in a different country and I have to take any job possible to manage that. And so I think the questions for this kind of a conference are, how does insurance relate to this? And another very key big question for this kind of a conference is about this fundamental issue that's been unpacked from different directions about, okay, if the polluter should be paying, the people causing the problems should be compensating people for the problems that other people that they're burdening them with the problems. How does insurance fit into this complicated question? And I have to say, there's not going to be an answer that a panel can say, because it's going to depend on the specifics of different situations. Unless insurance is just so bad, we should not do it at all, which could be the case. I don't believe that's the case. So one of the issues is you'd say, okay, I want to subsidize the insurance using the donor money because we owe it. The problem is that is a subsidy that encourages me to put myself in harm's way. I have to shoot myself in the foot to get that subsidy. Maybe we should just be giving people that subsidy or using a different mechanism to give them the subsidy or address the damages. So insurance may not be the right mechanism, and insurance may just be a tool to help make sure things are done more efficiently. And those are the kinds of questions that we have to ask as we look at these different projects. It's one of those things where insurance, when you're subsidizing it, it can also cause, let's say you have a common property resource like rangelands or a fishery. If you subsidize the insurance for that resource, you may, one, be encouraging people to do maladaptation or not moving on to the next livelihood that you should be supporting their transition to. But if there's common properties or other market failures, you may be encouraging them to stock more or fish more and actually degrade the resource. So these kinds of questions have to be thought of when you're designing these products. And so again, it may be that the insurance itself is not the piece that's subsidized. And unfortunately, usually the resources that you have to address these questions are relatively small and used up fairly quickly. So I think one of the things we should be thinking about is how do we make sure that before they're used up, they go to the most important things. And I think some of the most important things are really the inputs, the resources, the education, the information structures, the government ministries, the education. Those kinds of things are probably where the money should go first. And we also don't want to just be saying, okay, we're going to force a whole country to buy insurance and we're going to mostly pay for it. And now we've washed our hands of this obligation. We don't want to be doing that. We really want to be addressing things. And so thinking about, as many people have mentioned, how the insurance can solve problems, how it can fit into these different roles of perhaps helping a farmer adapt and become more effective, helping a government or UN agency address hunger. Those may be different things. Well, those are different things. And probably insurance has different roles, and there may be complementary pieces and different uses of different kinds of resources we want to be thinking about in those. And I think as I tried to make it so that my notes are up high, so it looks like I'm thinking, but I can't read it. So it's kind of pointless. The thing that we want to remember is that these are difficult questions that all require that our understanding in this northern place that many of us are in has to be reconciled with the experts within the countries and also reconciled with the end beneficiaries, the farmers themselves or whoever the product is being designed to work with. And that is by far where the biggest amount of work is. And we should always be focusing on that instead of an easy way out of just ticking a box. And I think that that speaks to many of the climate justice issues where people really, and anti-colonization issues, where people who are the beneficiaries, the local experts, the governments that have the local governance that we should be respecting, they have to have a very meaningful and iterative input in how the solutions are built. And those are the kinds of things that we've been not doing enough at in projects like index insurance. We have to reconcile the experience of a satellite with the experience of a farmer on the ground to solve the problem, whether we're doing insurance or not. And those kinds of things in insurance projects, when those are being done, it's quite exciting. And that's what attracts me to insurance. And I think with other people on this call, and they're not impossible. I mean, in Zambia, we were just talking about, we just went with the Ministry of Agriculture to the whole country where 1 out of 7 villages was interviewed and the satellites were discussed with the experiences of the farmers for every 7th village in the whole country. And it only took them a couple of weeks. We should be doing that much, much more. And that information needs to go into not only the policy, but the nitty gritty of finding the right solutions. Because that's what's required to come up with real good solutions in something that's complicated. And it's also justice. It's also respecting the authority of people who've been elected to power. And it's also helping to, if we're any good at it, it's helping give the people a voice to help undo some of this colonial structure that we're living under. I mean, even I think the logo, this conference webpage has King George's crown in the logo as required by laws older than the U.S. government. So anyway, I wanted to say that, again, the important thing is we focus on what we're solving, use things as solutions, and make sure that the end beneficiary, local experts, and appropriate governance drives the decisions. So thanks a lot. This was a great discussion.
Awesome. Thanks so much, everyone, for joining from all over the world and different time zones. I really enjoyed this conversation, and we'll have a recording and people let me know if you'd like access to it. Have a great day and keep doing the really interesting and awesome work you do. Thanks for sharing.
Thanks.
Thanks a lot. Goodbye.
Bye.
Thanks so much.
Beth and Max.
Thanks, everyone.
All right.